Have you ever wondered why a stock suddenly crashes, even though the company looks strong? Or why a stock shoots up, only to fall right after retail investors jump in? Today, we're talking about how large institutions can influence and sometimes manipulate share prices. Let's break it down in simple terms. What are institutions? In the stock market, institutions refer to large financial players like hedge funds, investment banks, mutual funds, and pension funds. Firms such as Goldman Sachs, BlackRock, and JPMorgan Chase manage billions, even trillions of dollars. Because of their size, when they buy or sell, markets move, and that's where things get interesting. First, accumulation and distribution. Institutions don't just buy all at once. They accumulate shares slowly, buying quietly over days or weeks, so the price doesn't spike too early. Once the price rises and retail investors start buying in, they distribute, meaning they sell into the excitement. Retail traders buy the top. Institutions sell at profit. This cycle repeats constantly. Second, stop-loss hunting. Many retail traders place stop-loss orders just below support levels. Institutions can see liquidity zones, areas where many stop-losses are clustered. They may push the price down briefly, trigger those stop-losses, create panic selling, then buy at lower prices. The chart looks like a fake breakdown, but it was a liquidity grab. Third, news and sentiment timing. Sometimes markets move before news becomes public. Big players often react faster or position themselves in advance. For example, a stock may rise before positive earnings are released or drop before bad news hits headlines. This creates the feeling that smart money knew first. Fourth, pump and dump. More common in small caps. In smaller stocks, manipulation is easier. A stock gets hyped through social media, newsletters, or rumors. Retail investors rush in, price spikes. Then large holders sell into the surge, price collapses. This is illegal, but it still happens, especially in low-volume stocks. Fifth, is it always illegal? Not necessarily. There's a difference between strategic trading and illegal manipulation. Legal behavior includes building large positions strategically and using algorithms to optimize entry and exit. Illegal behavior involves spreading false information, coordinated pump and dump schemes, and wash trading. Regulators like the U.S. Securities and Exchange Commission monitor markets to prevent fraud, but proving manipulation is difficult. Smart money versus retail. Institutions have advantages: faster execution, better data, advanced algorithms, and direct market access. Retail traders often react emotionally. Institutions often trade systematically. That difference alone can move markets. Important reminder: not every drop is manipulation. Not every spike is a trap. Sometimes price moves are simply supply and demand, but understanding how institutions operate helps you avoid emotional trades, recognize fake breakouts, and be patient with entries. Final thoughts. Markets are not random. They are driven by liquidity, psychology, and large capital flows. Institutions don't control everything, but they definitely influence price. The key question is, are you trading with smart money or against it? If you found this helpful, consider liking and subscribing for more breakdowns on trading psychology and market strategy. And remember, trade smart, stay patient, manage risk.